The 5 investment mistakes that keep you poor. Estimated duration, 7 minutes. The best investment advice is not always about what you should do. Sometimes, the most valuable advice is knowing what not to do. Because when it comes to investing, you don't need to discover the next Amazon, Bitcoin, or Nvidia to build wealth. You simply need to avoid the mistakes that quietly destroy it. And the scary part? Most of these mistakes don't look dangerous at first. They look exciting. They look intelligent. Sometimes, they even look like opportunities. Today, I'm going to show you 5 investment mistakes that can keep you poor for years, plus 1 bonus mistake that can destroy decades of progress in just a few days. And at the end, we'll talk about some of the biggest lies the financial industry tells ordinary investors. Let's begin. Mistake number 1. Trading instead of investing. This is probably one of the most expensive mistakes beginners make. They enter the market thinking investing means constantly buying and selling. A stock goes up 5%? Sell it. A stock drops 10%? Panic. A new company is trending online? Buy immediately. This isn't investing. It's reacting. Real investing is usually boring. You buy productive assets with the expectation that they will grow in value over many years. Trading, on the other hand, creates the illusion that you always need to be doing something. And that's dangerous. Every trade gives you another opportunity to make an emotional decision. Fear. Greed. FOMO. Impatience. Imagine buying a strong investment and holding it for 20 years. Now compare that with making hundreds of decisions every year about when to buy, when to sell, when to jump back in, and when to get out. Which strategy gives you more opportunities to make mistakes? Exactly. Wealth is often built through patience, not activity. The market rewards people who can wait. Mistake number 2, following gurus and influencers. 4 hot tips. You've probably seen them. This stock is about to explode. Buy this before everyone else finds out. This crypto could make you rich. And of course, this opportunity will disappear in 24 hours. Be careful. If someone online really had a guaranteed way to turn $1,000 into $100,000, ask yourself one simple question: why do they desperately need you to buy their course? Hot tips are attractive because they make investing feel easy. Someone else does the thinking. You just follow the recommendation. But when the investment falls, that influencer isn't going to pay your losses. You will. Never buy an investment simply because someone with a large audience says it's going up. Ask, what exactly am I buying? How does this business make money? What are the risks? What would make me sell? And most importantly, would I still buy this if nobody on social media was talking about it? If the answer is no, you're probably following hype instead of investing. Mistake number 3, trying to time the market. This one sounds reasonable. Why not wait until the market crashes, buy at the bottom, and sell at the top? Because there's one problem. You don't know where the bottom is. And neither does anyone else. People have been predicting crashes for decades. Sometimes they're eventually right. But being right about a crash isn't enough. You also have to know exactly when to sell before it happens, and exactly when to buy again afterward. That's 2 perfect decisions. Think about what happens during a major market decline. Fear is everywhere. News headlines are terrible. Experts are predicting disaster. Your portfolio is falling. And that's supposed to be the moment when you confidently put more money into the market? That's much harder psychologically than it sounds. Many investors wait for certainty. But by the time everything feels safe again, markets may already have recovered significantly. Instead of trying to predict every move, many long-term investors consistently invest over time. Month after month. Year after year. They don't need to know what the market will do tomorrow. Their advantage is time. Mistake number 4, paying high fees. This mistake is quiet. You don't see dramatic headlines about it. But over decades, fees can consume an enormous amount of money. Imagine two investments earning similar returns. One charges very low annual fees. The other charges 1%, 2%, or even more when management costs and other expenses are included. 1% doesn't sound dangerous. But remember, you're not paying that fee once. You're paying it again and again. Year after year. And you're also losing the future growth that money could have earned. That's why investment costs matter so much. Many traditional mutual funds charge significantly more than low-cost index funds. Does that automatically make every mutual fund bad? No. But if you're paying higher fees, you should understand exactly what you're getting in return. Never assume expensive means better. Sometimes the simplest investment is also one of the most efficient. Fees are one of the few parts of investing you can actually control. So control them. Mistake number 5, investing without a plan. This may be the most important mistake on the entire list. Buying investments without knowing why you're buying them. Someone says stocks are going up. You buy stocks. Crypto is trending. You buy crypto. Real estate is popular. Now you want real estate. A month later, gold is making headlines. Suddenly you want gold. That's not a strategy. That's financial wandering. Before investing, you need answers to basic questions. What is the money for? Retirement? A house? Financial independence? How long can the money remain invested? 5 years? 10 years? 30 years? How much risk can you realistically tolerate? And here's the most important question: do you understand what you're buying? If you cannot explain an investment in simple language, you probably shouldn't put your money into it yet. Complexity is not the same as intelligence. A simple plan you understand is usually better than a complicated strategy you abandon during the first crisis. Bonus mistake: panic selling during a crash. This is where many investors turn temporary losses into permanent losses. Markets fall. Your portfolio drops 20%. Maybe 30%. You become terrified. You sell everything. And immediately, you feel relief. At least you're no longer watching your account fall. But now you have another problem. When do you buy back in? Most people say, when things get better. But markets often begin recovering before the news gets better. By the time confidence returns, prices may already be much higher. This creates one of the worst investing patterns imaginable: buy when everyone is optimistic. Sell when everyone is terrified. Then buy again after prices recover. You are buying high and selling low. Repeatedly. Crashes are painful. But for long-term investors with diversified portfolios and appropriate risk levels, falling prices can also mean assets are becoming cheaper. The moment that feels emotionally like the worst time to invest can sometimes create some of the best long-term opportunities. The lies the financial industry tells you. Here's something worth remembering. The financial industry makes money when investors are active. New products. New funds. New predictions. New opportunities. New reasons to move your money. Why? Because complexity can be profitable. You may be told that investing is too complicated to understand. That you constantly need expert predictions. That you need to find the next big winner. That more activity means better results. That expensive investments must be superior. But successful investing is often much simpler than the industry makes it sound. Spend less than you earn. Build an emergency fund. Invest consistently. Diversify. Keep fees low. Understand what you own. And give your investments time to grow. That's not exciting. It won't make a great get-rich-by-Friday advertisement. But that's exactly why it works. The biggest danger to your portfolio may not be the stock market. It may be your own impatience. Remember, you don't have to make perfect investment decisions. You simply have to avoid enough terrible ones. Because the best investment advice isn't always about what to do. Sometimes, it's knowing exactly what not to do.